It already happened. Not a hypothetical, not a maybe, not a scary story to keep you watching. On May 16th, 2025, Moody's stripped the United States of the last perfect credit rating it had left, dropping it from AAA to AA1. And for the first time in over 100 years, since 1917, every single major credit rating agency in the world now agrees that America is no longer a perfect borrower. Standard & Poor's did it first, back in August 2011, cutting the rating from AAA to AA+ in the middle of a brutal debt ceiling standoff that nearly forced the government into default. Fitch followed in August 2023, cutting the same notch, citing the same disease, a mountain of debt with no real plan to bring it down. And then Moody's, the last holdout, the one agency that had defended America's perfect score through 2 world wars, the Great Depression, the 2008 financial crisis, and every recession in between, finally gave up the fight in 2025. 3 strikes, 3 agencies. One conclusion. The richest, most powerful economy on earth is no longer considered a flawless credit risk. And if you think that sounds like a technicality, something only bankers in suits should care about, stay with me, because this single letter grade quietly reaches into your mortgage, your credit card, your grocery bill, your retirement account, and the value of the dollar sitting in your wallet right now. Let's start with the basics, because understanding this changes how you see every headline about the economy for the rest of your life. A credit rating is exactly what it sounds like, a report card for a borrower. When a country borrows money by selling bonds, agencies like Moody's, S&P Global, and Fitch study that country's finances, its debt levels, its political stability, its ability to pay interest on time, and they assign a letter grade that tells investors around the world how safe it is to lend that country money. A, or AA in Moody's language, is the highest possible score, reserved for borrowers considered essentially bulletproof. It tells a pension fund in Norway, an insurance company in Germany, or a central bank in Saudi Arabia that lending money to this government is about as safe as lending gets. Drop 1 notch, and the borrower is still considered very strong, but no longer flawless, and that tiny difference matters more than most people realize, because trillions of dollars in global investment rules are built around these letter grades. Some of the largest pension funds, insurance companies, and money market funds in the world are legally or contractually required to hold only the highest rated bonds. When a downgrade happens, some of these institutions are forced to reduce their holdings, not because they suddenly distrust America, but because the rule book they operate under says so. Now, let's follow the ripple, because this is where the story stops being abstract and starts becoming personal. Meet Daniel, a 38-year-old high school teacher in Columbus, Ohio, married with 2 kids, a modest house he's been paying off for 9 years, and a retirement account he checks maybe twice a year because looking too often stresses him out. Daniel doesn't watch financial news. He's never read a Moody's report in his life. But on the morning the downgrade news breaks, his phone buzzes with a headline anyway, because it's everywhere, on every app, every network, every scrolling ticker. He shrugs it off on his way to work. Nothing around him looks different. The coffee shop is open, the highway is full, his students still show up late to first period. But behind the scenes, in trading floors and fund offices thousands of miles away, something has already shifted. Some of the world's largest bond buyers begin trimming their Treasury holdings, or at least demanding a little more return for the risk they're taking on. As demand softens even slightly, prices on existing bonds dip, and because bond prices and bond yields move in opposite directions, yields start climbing. That single mechanical relationship, prices down, yields up, is the hinge that the entire rest of this story swings on, because Treasury yields are the benchmark for almost every other interest rate in the American economy. Mortgage rates are priced off the 10-year Treasury yield. Auto loans, business loans, corporate bonds, even the interest on your credit card, all of them get more expensive when Treasury yields rise, because lenders across the economy use government debt as their baseline for what's considered a safe return, then add their own risk premium on top. So when the downgrade sends yields higher, it isn't just Wall Street that feels it. Within days, Daniel notices the mortgage refinance he'd been quietly considering, the one that would have knocked $80 off his monthly payment, has evaporated. The rate his loan officer quotes him now, instead of saving him money, would barely break even after closing costs. This isn't speculation, by the way. It's exactly what happened. On the Monday after Moody's downgrade in May 2025, the average rate on a 30-year fixed mortgage climbed as high as 7. Multiply Daniel's stalled refinance by millions of households across the country, all quietly deciding to wait, to hold off, to not buy that car or that house or expand that small business this year, and you start to see how a single letter grade turns into a drag on the entire economy, not through some dramatic collapse, but through millions of small, cautious decisions made in kitchens and living rooms all at once. Businesses feel it too. When it becomes more expensive for a company to borrow money to build a new warehouse, hire more staff, or expand into a new market, some of those projects simply get delayed or shelved entirely. Corporate treasurers, Watch Treasury yields the way sailors watch the wind, because corporate borrowing costs are built directly on top of government borrowing costs. When the baseline rises, the whole structure above it rises too. Stock markets, meanwhile, tend to react with a kind of nervous energy that can look wildly different depending on the moment. Let's rewind to the very first time this happened, August 2011, because it's the clearest lesson in how markets can behave in ways that defy common sense. When S&P downgraded the US for the first time in history, the reaction wasn't calm. It was violent. The Dow Jones Industrial Average plunged 634 points that Monday, one of the worst single-day point drops the market had ever seen at that time, and the S&P 500 fell roughly 6.7% in a single session, continuing to slide until it was down over 8% within a couple of months. Global markets followed the panic. Britain's FTSE dropped 2.7%. Germany's DAX sank 4.7%. France's CAC 40 fell over 4%. Asian markets bled red across the board. And here's the part that broke the textbook logic almost everyone expected. Even though US debt had just been downgraded, meaning in theory it should have looked riskier, investors panicked and ran straight into US Treasury bonds anyway, treating them as the safest place on the planet to park money during chaos, even chaos caused by their own downgrade. Demand for treasuries actually rose. Yields, instead of climbing as the textbook would predict, fell, with the 10-year yield dropping from around 2.56% before the downgrade to 2.32% within days, and continuing to slide toward 1.7% by early October. It was a strange, almost paradoxical outcome, proof that when the whole world is looking for safety, America's debt remains the default answer, even when that debt is the very thing being questioned. But not every downgrade plays out the same way. Fast forward to August 2023, when Fitch delivered the second downgrade, and the reaction was far more muted. The S&P 500 dipped a modest 1.55% the next day, drifted lower by around 5% over the following weeks, but there was no panic, no chaotic sell-off, no headline-grabbing crash. And by May 2025, when Moody's finally pulled the trigger on the third and final downgrade, markets barely blinked. The Dow actually rose over 130 points that Monday, up about 0.32%. The S&P 500 nudged up 0.09%. The Nasdaq crept up a tiny fraction of a percent. Analysts at Capital Economics summed it up bluntly, noting the downgrade hadn't made much of a market splash at all. Why the difference? Because markets, like people, adjust to repeated warnings. The first downgrade in 2011 was a genuine shock, something that had literally never happened before in modern history. The second, in 2023, was expected, priced in, absorbed with a shrug. The third, in 2025, felt almost like a formality, the last domino falling in a sequence everyone had already anticipated for years. This is an important lesson buried inside the story, one worth sitting with for a moment. Financial markets don't just react to facts, they react to surprise, and the less surprising something becomes, the smaller the reaction, even if the underlying problem, the debt itself, keeps getting worse in the background the entire time. And it has kept getting worse. Let's talk numbers, because this is where the story stops being about headlines and starts being about arithmetic that every American household is quietly paying for. As of early 2026, the total gross national debt of the United States sits above $38 trillion, and depending on which month you check, it's climbing toward $39 trillion, growing by roughly $7 to $8 billion every single day, which works out to somewhere around $85,000 every second. Pause on that. $85,000 a second. In the time it takes you to read this sentence, the debt has grown by more than most people make in a year. Broken down per household, that recent one-year increase alone works out to more than $20,000 added per household in the United States, on top of a total debt burden of roughly $289,000 per household when you divide the whole pile evenly. And here's the part that should really make you pause. It isn't just the size of the debt that matters, it's the cost of carrying it. In 2020, at the start of the pandemic, the federal government paid around $345 to $515 billion a year in interest on the debt, depending on how you measure it. By the first quarter of 2025, that number had rocketed past $1.1 trillion annually, nearly doubling in just 5 years. The Congressional Budget Office now projects that interest payments alone will hit roughly $1 trillion in fiscal year 2026, then balloon to $2.1 trillion by 2036, and a staggering $6.6 trillion annually by 2056. To put that growth in perspective, interest costs are projected to grow faster than any other major category in the entire federal budget over the next decade, increasing by over 100% in 10 years and by more than 500% over 30 years. Interest payments are expected to surpass total Medicare spending by 2028, surpass combined defense and non-defense discretionary spending by 2038, and become the single largest line item in the entire federal budget by around 2048, larger than the military, larger than healthcare, larger than education, larger than every other program combined. Think about what that means in plain English. The government is on a path where within a couple of decades, the single biggest thing it spends money on won't be soldiers, or hospitals, or schools, or roads. It will be interest, the cost of past borrowing, money paid simply to service debt that's already been spent, with nothing new to show for it. As of the first quarter of 2025, interest payments already consumed roughly 34% of all federal tax revenue, meaning only about 66 cents of every tax dollar collected was actually left over for everything else the government does: defense, healthcare, infrastructure, education, disaster response, scientific research, all of it competing for a shrinking slice of the pie. And every time old government debt matures and has to be refinanced, it often gets replaced at higher interest rates than before, which means the debt doesn't just sit there quietly, it actively compounds against the country's own budget in real time. This is precisely the mechanism every rating agency has pointed to. When Moody's made its call in 2025, it explicitly cited the increase over more than a decade in government debt and interest payment ratios to levels significantly higher than other countries carrying similar ratings, and projected that federal debt could balloon to as much as 134% of GDP by 2035, up from around 98% in 2024. Fitch, back in 2023, pointed to the same root cause, a debt-to-GDP ratio nearing 95% at the time, combined with what it bluntly called an erosion of good governance, referring to the repeated last-minute debt ceiling standoffs that have become almost a yearly ritual in Washington. And S&P, all the way back in 2011, used almost identical language, warning about the weakening effectiveness, stability, and predictability of American policymaking and political institutions. Read those three explanations side by side and you notice something striking. 3 different agencies, 3 different years, 3 completely separate downgrades, and yet the diagnosis barely changes. Too much spending, too little revenue, and a political system that keeps failing to agree on a real plan to close the gap. It isn't really about one president, one party, or one piece of legislation. It's a bipartisan pattern that spans multiple administrations, both parties fully included, each one adding to the pile in its own way. Now, let's step back and ask the global question, because America doesn't borrow in a vacuum, it borrows from the entire world. Foreign governments and investors hold trillions of dollars of you. S-debt, and as of the most recent data in 2026, foreign holdings of Treasury securities actually reached around $9.5 trillion, up roughly 6% from the year before, which tells you something important right away. The world hasn't abandoned American debt, not even close. Japan remains the largest single foreign holder, with holdings around $1.2 trillion. The United Kingdom follows at roughly $900 billion. China holds around $700 billion, a figure that has actually declined by more than 10% over the past year or so, as Beijing has been quietly diversifying part of its reserves into gold and other assets instead. China's central bank gold reserves climbed for something like 14 straight months through the end of 2025, a slow but steady signal that some countries are hedging their bets rather than betting everything on the dollar alone. But here's the nuance that a lot of viral headlines get completely wrong, because you've probably seen the claim online that China, Japan, or Turkey are dumping the dollar and abandoning America. The reality, according to the actual Treasury data, is far less dramatic. Japan's reduced buying has mostly come from private Japanese investment funds and insurers rotating into higher-yielding domestic Japanese bonds now that Japan's own interest rates have finally risen after decades near zero, not from any political statement by the Bank of Japan. Turkey's dollar sales are driven by its own domestic economic crisis, using dollar reserves to prop up its currency. Nothing to do with America's creditworthiness. And even China, despite trimming its treasury holdings, hasn't abandoned the dollar system. It's simply diversifying. The same thing a smart individual investor does with a retirement account, spreading risk across gold, equities, and other currencies, rather than keeping all your eggs in one basket. Meanwhile, other countries have actually been increasing their exposure to you, S-debt. During the same period, Saudi Arabia boosting its holdings by 19% in a single recent month, Canada increasing by 13%, with Belgium, Luxembourg, Norway, and the United Arab Emirates all steadily adding to their positions too. So the picture isn't a stampede for the exits. It's a complicated, shifting mosaic, some players trimming exposure for their own domestic reasons, others increasing it because, even with a downgrade attached, US, Treasury debt remains the deepest, most liquid, most easily traded bond market on the entire planet, a market so large and so essential to global finance that Treasury securities function almost like a universal financial language, used as collateral, used as a safe parking spot for cash, used as the reference point every other bond in the world gets measured against. That's the paradox sitting at the center of this whole story. The United States can lose its perfect credit rating 3 separate times, watch its debt climb past $39 trillion, and still remain the destination of choice for global capital during moments of fear, precisely because there's currently no realistic alternative of the same size and depth. The Eurozone is fragmented across multiple governments and multiple bond markets. China's bond market isn't nearly as open or as trusted by outside investors. Gold is a hedge, not a replacement, since you can't easily use gold bars to settle a $1 trillion transaction on a Tuesday afternoon. The dollar's role as the world's dominant reserve currency isn't guaranteed forever. Nothing in history is guaranteed forever, but it isn't unraveling overnight either, no matter how many alarming headlines suggest otherwise. Let's go back to Daniel for a moment, because the abstract global picture eventually lands right back on his kitchen table. Over the following months after the downgrade, he notices his grocery bill creeping upward, not dramatically, but steadily, the way inflation always seems to work, 5 cents here, $1 there, until one day the total at checkout is meaningfully higher than it was a year ago. His retirement account, invested mostly in a target date fund through his school district, swings more than it used to, up 3% one month, down 2% the next. Enough volatility that he starts avoiding logging in as often, not because he's panicking, just because watching it makes him uneasy. His insurance premium renewal comes in higher than expected. His credit card, which he mostly pays off but occasionally carries a balance on during the summer when the teacher paycheck gap hits, has a slightly higher interest rate attached than it did 2 years earlier. None of this, on its own, is catastrophic. Daniel still has his job. His kids still go to school, the house is still standing, the car still runs, dinner is still on the table every night. Life, stubbornly, keeps going. And that's actually the most important, least dramatic truth in this entire story. The one financial content online rarely wants to admit because it doesn't generate the same panic-driven clicks. A credit downgrade is not the same thing as a default. It is not the same thing as economic collapse. It is not the government suddenly unable to pay its bills tomorrow morning. Historically, every single time this has happened in 2011, in 2023, and in 2025, the stock market eventually recovered, and in the case of 2011, went on to enter a multi-year bull market that lasted the better part of a decade. After the 2023 Fitch downgrade, markets stabilized within a matter of weeks. After the 2025 Moody's downgrade, the reaction was so mild that financial writers were literally publishing articles asking, somewhat sarcastically, what downgrade? Because trading desks had almost entirely shrugged it off within 48 hours. So if a downgrade doesn't cause immediate collapse, what's the actual danger here? The thing worth paying attention to underneath all the numbers. It's not a single dramatic event. It's a slow, compounding erosion, a bit like a small leak in a roof that doesn't flood the house today or tomorrow, but if left unaddressed for decades, eventually rots the structure from the inside. Higher borrowing costs today mean less money available for the government to invest in things that actually grow the economy for the future: infrastructure, education, scientific research, all of it slowly getting squeezed out by a growing interest bill that has to be paid first, no matter what, the way a household with rising credit card debt has to pay the minimum before it can afford anything else. It means future generations inherit a bigger obligation with fewer resources to handle emergencies, whether that's the next pandemic, the next financial crisis, or the next war, because a country that's already stretched thin on debt has less room to maneuver when something genuinely urgent happens. It means everyday borrowing, mortgages, auto loans, small business loans, sits a little higher than it otherwise would, a quiet tax on ambition that touches nearly every major financial decision an ordinary family makes. And it means the world's perception of American reliability, built patiently over more than a century, chips away just slightly with each downgrade. Not enough to trigger a crisis today, but enough that the margin for error keeps shrinking. With every passing year, the debt problem goes unaddressed. There's also a quieter, more unsettling layer to this conversation worth mentioning honestly. The United States is no longer the only game in town when it comes to top-tier credit. As of recent ratings, a small club of countries still holds the pristine AAA grade from all three major agencies, including Germany, Denmark, the Netherlands, Sweden, Norway, Switzerland, Luxembourg, Singapore, and Australia. None of these economies rival America's overall size or global influence, not even close. But their existence is a quiet reminder that fiscal discipline is a choice some governments still make, even when it's politically uncomfortable, even when it means saying no to popular spending or unpopular taxes, a discipline that has become increasingly rare in Washington, regardless of which party holds power. So where does this leave us, sitting here in the middle of an ongoing story that doesn't have a tidy ending yet? The debt clock keeps ticking, somewhere around $85,000 a second as you're hearing this, and it shows no sign of slowing down on its own. Interest payments are on track to become the largest single expense in the federal budget within the next couple of decades. Larger than the military, larger than Medicare, larger than everything else combined. Global investors haven't abandoned America. Not even close, but they're clearly diversifying at the margins, adding a little gold here, trimming a Treasury position there, hedging quietly rather than making dramatic public statements. Ordinary families like Daniel's absorb the consequences, not through some single dramatic headline morning, but through 1,000 small frictions spread across years. A slightly higher mortgage rate here, a slightly pricier grocery run there, a retirement account that swings just a bit more than it used to. And policymakers so far keep responding to each downgrade with statements of reassurance rather than the kind of structural reform that would actually bend the trajectory of the debt curve downward. The same pattern that's repeated after 2011, after 2023, and again after 2025. It also helps to understand the actual mechanics of how this cycle keeps repeating itself, because almost every downgrade in American history has been tangled up with the same recurring political ritual, the debt ceiling. The debt ceiling is a legal cap Congress sets on how much the federal government is allowed to borrow in total. And because the government routinely spends more than it collects in tax revenue, that ceiling has to be raised again and again just to keep paying bills that Congress has already agreed to. Salaries, Social Security, Medicare, interest on existing bonds, none of it optional once it's been promised. Raising the ceiling doesn't authorize a single dollar of new spending. It simply allows the Treasury to pay for spending that's already been approved, yet somehow it has become one of the most politically explosive rituals in Washington, a recurring standoff where one party or another threatens to let the country miss payments entirely unless certain demands are met. In 2011, that standoff went down to the wire with an actual X date, the point at which the Treasury might no longer be able to pay all its bills, looming just days away before a last-minute deal was struck, and S&P specifically cited that dysfunction, not the debt level alone, as a central reason for the downgrade. The same drama repeated in 2023 before Fitch's downgrade, and again in the lead-up to the 2025 Moody's downgrade, with analysts once more tracking an estimated X date sometime between summer and fall of that year. It's a strange design flaw baked into the system, a self-inflicted crisis that the country manufactures on a semi-regular basis, purely through political brinkmanship, over money that's already been spent. Imagine a household that's already committed to a mortgage payment, a car payment, and a phone bill, and then, right before the due date each month, the two adults in that household get into a screaming argument over whether to actually transfer the money, even though they both already agreed to spend it weeks earlier. That's roughly what a debt ceiling standoff looks like from the outside. And it's precisely the kind of governance risk that keeps showing up downgrade after downgrade in the official language of every rating agency involved. Zoom out far enough, and the household comparison actually holds up reasonably well as a teaching tool, with one crucial difference worth keeping in mind. A family that keeps adding debt every year, refinancing at higher rates and spending more than it earns, eventually hits a wall, a bank stops lending, a car gets repossessed, a house gets foreclosed. The federal government doesn't face quite the same hard wall because it borrows in its own currency, controls its own central bank, and can, in a real crunch, effectively create more dollars to cover obligations, something no ordinary household or business can ever do. That flexibility is exactly why economists disagree so sharply about how urgent this problem really is, some arguing the debt is a slow-motion emergency that demands immediate, painful fixes, tax increases, spending cuts, entitlement reform, all deeply unpopular with voters, and others arguing the U.S. has more room to run than the panic suggests, pointing to Japan, a country that has carried a debt-to-GDP ratio for decades far higher than America's current level without collapsing, as proof that these thresholds aren't as fixed or as dangerous as some doomsday forecasts claim. The honest answer probably sits somewhere between those two camps, closer to the cautious middle than either extreme, which is exactly why credit rating agencies keep landing on the same measured language every single time, not screaming collapse imminent, but steadily, patiently, downgrading a notch at a time, a persistent, quiet warning rather than a 5-alarm fire. Maybe the most honest way to close this out is with the same lesson history keeps handing us over and over, whether it's 2011, 2023, or 2025. A credit rating is not a prophecy, it's a warning label, a single letter grade that reflects years of accumulated decisions, both good and bad, made by presidents and Congresses of every political stripe going back decades. It tells you something true about risk without telling you the whole story about resilience, because resilience comes from somewhere else entirely, from a diverse, innovative economy that keeps producing new companies, new technologies, and new jobs, even while the government argues over budgets, from the sheer depth and liquidity of American financial markets that the rest of the world still can't fully replicate anywhere else, from an independent central bank that markets still broadly trust to manage monetary policy without political interference, and from the simple, stubborn fact that changing the world's dominant reserve currency is one of the slowest, hardest things to do in all of global finance, something that has only happened a handful of times across all of human history, and never quickly. None of that is a free pass to ignore the debt problem, and none of it means the warnings from Moody's, S&P, and Fitch should be waved away as overblown noise. It simply means the honest answer sits in the uncomfortable middle ground between the two extremes you'll find online, somewhere between nothing to see here and the sky is falling. A country that is genuinely spending beyond its means in a way that compounds against its own future, sitting inside an economy still powerful and resilient enough to absorb the consequences for now, buying time, but not buying forgiveness, and definitely not buying an unlimited amount of time either. Every additional trillion added to the pile, every additional downgrade, every additional percentage point added to interest payments as a share of federal revenue narrows that margin just a little more, and at some point, a margin that keeps narrowing for long enough eventually runs out, the way it always has for every over-leveraged borrower in history, whether that borrower is a person, a company, or a country. Whether that reckoning arrives in 5 years, 25 years, or gets pushed back further through reforms nobody in Washington has shown much appetite for yet, is genuinely one of the biggest open questions hanging over the entire global economy right now. And it's one worth paying far more attention to than a single scary headline about a letter grade dropping from AAA to AA+, because the letter grade was never really the story, it was just the messenger. And the real story, the one still being written in real time, $1 trillion at a time, is what America, and by extension every household connected to its financial system, decides to do about it next.